Hello, dear friends. Who wouldn't want to save a little extra from their hard-earned salary? Understanding the house rent allowance, or HRA, can be your golden ticket to optimizing your tax. Today, we delve into the nitty-gritty of calculating taxable HRA under Section 10, 13A of the Income Tax Act, 1961. First, a quick primer. HRA is an allowance granted by employers to employees to meet the cost of renting a home. Not all of it is taxable, and rightly so if you know how to calculate the taxable portion. Step 1 involves determining the actual HRA received from your employer. This figure is usually mentioned in your salary slip or employment contract. Moving to Step 2, calculate the actual rent paid annually. Then subtract 10% of your salary from this amount. Remember, salary here includes your basic pay, dearness allowance if applicable, and any commission based on a fixed percentage of turnover. The third step is to assess the HRA exemption. This is the minimum of 3 amounts: the actual HRA received, 40% of salary for non-metros or 50% for metros, and the amount calculated in Step 2. The final step is straightforward. To find the taxable portion of HRA, subtract the HRA exemption figured out in the third step from the total HRA received. The result is the amount that will be included in your taxable income. In summary, calculating your taxable HRA involves these key steps. Determine your actual HRA received, calculate the excess rent paid over 10% of your salary, figure out the least value among the actual HRA, specified percentage of salary, and excess rent paid, and finally, subtract the HRA exemption from your received HRA to find the taxable portion. Understanding these steps can significantly reduce your tax liability and increase your take-home salary. Isn't it wonderful how a little knowledge can go a long way in boosting your financial health? Keep these points in mind when planning your taxes and make the most out of your HRA benefits.